We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Adam Hamilton, founder of zealllc.com. Adam, thanks for joining me again. How are you?
Outstanding, Tom. Thanks so much for having me, man. Good to see you.
Good to see you too. It's always a pleasure to speak with you and, chat both on and off of the recording here. But, it's always a pleasure to speak with you because you have so much study and so much data within the gold market because you're paying attention to it seemingly all the time. But I thought we could start today by, looking at some of the historical moves of gold markets past. This is something that I think is really important to be able to get some perspective on in these times, because, despite gold being basically at all-time highs, let's say tens of dollars from all-time highs, it's easy to feel like momentum has been lost within this sector. It's easy to feel like there's no excitement at the moment. So why don't we start by kind of talking a little bit about the let's say 10+% gains in gold markets past and how those have kind of materialized through time after that.
Oh, that's a fantastic topic, Tom. I actually looked at that recently. As you and your listeners know, back in mid-April, gold was shooting higher. People were getting pretty excited about it. Sentiment was turning bullish. Gold was doing awesome. And gold got really stretched. It rallied so far, so fast that it stretched 6% above its 200-day moving average. And so I had to do some historical studies. I decided to go back to 1971. I looked at the entire span of gold, 54.4 years of gold history back in mid-April, just to see, history doesn't repeat itself necessarily in markets, but certainly rhymes. There's patterns, up legs and corrections, bulls and bears are driven by human greed and fear, which never changes, herd behavior. And I found out that since January 2011, there had been only 3 trading days, 3 closes where gold closed more than 26% plus above its 200-day moving average. So that degree of overboughtness was extremely rare. That really interested me. It's funny you mentioned the 10% plus move. 10% plus sell-off is a correction, below 10% is a pullback. I looked at every 10% plus gold move in either direction since 1971. And I ranked all the bulls and bears within that whole, half century plus span. The 1970s ones were just massive, but I think those were kind of unique, Tom, because that's, of course, when the US dollar was taken off the gold standard. You can only devalue your currency, remove it from gold one time. And so I think those bulls were pretty unique when gold was finally free floating from the dollar. So I have the 1970s bulls in my spreadsheet, but for the purposes of this little analogy I'm going to do, I excluded those. I also exclude today's bull, which is a monster. Between early October 2023 in early May 2025, this current gold bull was up 88.1% without a single 10% plus correction. That is just absolutely massive. I classify up legs as monster status if they go over 40% without correcting 10% plus. So to go 88% without a correction is incredible. Mm-hmm. But anyway, Tom, if you look at the top 10 bull markets since 1971, excluding the 1970s and excluding today's, their average gain was like 58%. Ours is 88% again. But more interesting, after those next 10 largest bulls, the average correction was 15.5% over a fast 1.9 months. And the really crazy thing is their average peak relative to gold's 200-day moving average was 1.265 times at 26.5% above their 200 EMA, which is about exactly where gold was in mid-April. So I've been looking for a correction in gold since mid-April, the last couple months. I haven't had one yet. We had a couple minor pullbacks since mid-April. The biggest one was 7.1% into mid-May. That's the second biggest pullback of this mighty cyclical bull. The first one was back in October after Trump won the election. The U.S. dollar surged. That's gold fell 8.0% into mid-November, 2024. And so so I've been looking for a pullback based on a correction based on historical studies, but it hasn't happened, and there's some interesting reasons for that. But so it's really important to look at history and just see what gold's done before, and that gives us an idea of what we might be able to expect this time around.
Mm-hmm. So, Adam, once we see, basically some of these massive up legs, what does your study tell us about the corresponding down leg that, you know, keeps this bull market intact?
Yeah, that's exactly it. After those next 10 biggest bulls, again, 15.5% correction in gold over an average of 1.9 months. So
Mhm.
you have to rebalance sentiment. When something rallies too far too fast, the risk is it pulls in too many near-term buyers too soon. People who want to buy gold, there's a finite population, finite capital who are interested in buying gold the next week or day or month or whatever.
Mhm.
And so when something rallies too far too fast, it just pulls in all available near-term capital, and that risks burning out up legs or even entire bull markets prematurely.
Mhm.
So it's really important to have a corrective phase after these big and fast runs. That can happen a couple ways. The best way, in my opinion, is a correction, a 10% plus sell-off. That really bleeds off greed fast. People see gold fall, the late buyers start to get out, they pile onto the selling. You get the whole thing over with pretty quick. But instead of correcting, what this huge monster up leg mighty cyclical bull has done in the past 18 months or so is it's consolidated high. So gold will go up really fast, really far. But then instead of correcting, it'll just drift sideways for a month or two, 2.5 months. And that gradually works off greed. People get bored, they get apathetic. Once those big gains are gone, the momentum chasing players just kind of forget about gold. I think that's where we are today in mid-June, 2025. But that's good. That's healthy. We want people to not be too excited about gold, and that reloads gold for the next up leg higher, the next run higher, the next phase of its bull market. And so these corrective phases are really good, whether they're high consolidations or outright 10% plus sell-offs. Really happy to see them.
Well, you touched on a word there that I think perfectly describes the, let's say, sentiment right now, and that's apathetic. Do you have a way of measuring sentiment in previous bull markets? And is this time, oddly different from, let's say, the Western investor apathy perspective?
Well, sentiment is obviously really ethereal. Herd how the herd how people as a group, how traders of a group feel about gold. I've been in the financial newsletter business now for 26 years, and one thing I look at is my incoming email traffic, both the amount of emails I get interested in things, the people who write, and also whether they're bullish or bearish, positive or negative on the near-term fortunes of gold. And apathy is a great word for it because people just there's really not much coming in. There's not much feedback. You know, Views are down, and I talk with other newsletter writers, and people are seeing the same thing. There's other, podcast gurus like you who've told me that just people aren't interested. The views on their videos they're posting aren't what they expect them to be.
Mhm.
So there's just a huge amount of apathy right now. People just don't seem interested in gold, which is unbelievable considering it's like you said, right all-time highs effectively. And so the apathy is kind of frustrating as a gold stock guy, but it's good as well because if apathy is kind of the opposite of greed, people can't be greedy if they just don't care about a sector. And I think there's a lot of factors that feed into this apathy. But yeah, it's definitely a huge apathy out there. People don't care, indifference to gold. And that's probably a good thing for gold's next leg higher.
Mhm. So thinking about what has driven gold to the prices that we're now seeing here, Adam, do you think there's, let's say, different news that has moved gold than we have seen in the past?
Absolutely. I've never seen an up like this before, Tom, in that 26 years of studying the markets all day, every day. It's just absolutely incredible. Usually there's two main drivers of major gold uplegs. And that's American stock investors buying the dominant gold ETF shares in the world, GLD and IEU, the big American gold ETFs. There's also GLDM now. That's the sixth largest gold ETF in the world. That's kind of an upstart one. The GLD minis, just a lower share price, make it more accessible for people. Also, a lower annual management fee, 0.1% of net assets per year compared to 0.4% for GLD itself. And the second normal driver of gold uplegs is speculators gold futures trading, American speculators gold futures trading, and neither of those has been a factor in this mighty cyclical bull since early October 2023. Speculator gold futures positioning right now is actually really low. One way I look at that is I look at the highest spec longs are within a given gold bull, and the lowest spec longs are. Longs tend to outnumber shorts by like 4 or 5 to 1, so they're more important for moving gold.
Mhm.
And right now, that longs are only 25% up into this gold bull's trading range. Usually, after a big bull, they'd be at 90, 95, even 100%, implying that speculators are tapped out for their gold futures buying. And the total GLD and IU holdings build, meaning American stock investors buying those gold ETF shares. So those gold ETFs have to, shunt that capital in the physical gold bullion. They're up around 10% since this gold up leg started. So they don't explain this 88% gold move over the past 18 months or so. But what does is central bank buying and more importantly, Chinese demand. Chinese demand has just been absolutely incredible. And that was a big factor at this latest April surge as well. As you know, back in early April, Trump had his Liberation Day press conference and he put on those just absurd reciprocal tariffs, just absolutely huge, embargo grade tariffs effectively, just shut down trade between countries. And so Chinese investors were facing 145% tariffs on the important China factory export sector, selling stuff to America. I've heard that's about 1/8 of China's economy. I thought it was larger, but that's the stat I've seen. But still, it's a big chunk of the economy.
Mhm.
So Chinese investors are seeing this and they're like, man, how are our stock markets going to fare if a lot of our companies are going to lose a lot of their sales and have huge profits hits if their export markets are compromised? And I think they flooded into gold. I've been looking into this, Tom. This Chinese demand is kind of harder to track down than Western demand. The stats aren't as good. The data published isn't as good. But as near as I can tell, there's 4 major gold ETFs in China. And there's also the Shanghai Gold Futures Exchange. That data is a little bit easier to get, but there's just absolutely incredible volume on the Shanghai Gold Futures Exchange for gold futures back in early April. And those 4 Chinese gold ETFs, this number isn't exactly right, but it's close. It's ballpark. Their holdings, their total holdings grew something like 65% in April alone. Just absolutely incredible growth. So that I don't know if that was a popular speculative mania, but it was close. So it certainly frenzied demand.
Mhm.
And it's really interesting because the Chinese have been driving this gold bull for the most part. Also, big central bank buying. Um, the 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 gold futures speculators low positioning, not their longs again are only a quarter up into their trading range throughout this entire bull run. I think that's the reason why gold is consolidated high rather than correcting. I totally expected a 10% plus correction back in mid-April, was wrong in that.
Mhm.
But gold has drifted sideways since then. It's gradually bleeding off greed. It's got this point of apathy. Apathy isn't fear, but it's way better than greed. And I think that'll change. We're also in the summer doldrums, as you know, Tom. You've been in these markets for decades as well, and people just June is vacation season, man. People in the northern hemisphere, where most of the world's population is, kids are home from school. The weather's beautiful. The days are long. The sunlight's great. Markets just take a back seat to more important things in life this time of year. And so apathy strikes stock markets this time of year. It's struck gold forever in the summer doldrums in June. So I think it's kind of normal this time of year.
Mhm. Adam, before we get to the doldrums idea, do you think that a resolution or let's say clarification in which tariffs are going to be imposed could signal a sell-off and a possible correction that you were expecting here?
That's one of my near-term fears for gold, Tom, that there'll be some great trade news. Trump will announce via Truth Social someday that, hey, we made this deal with this country, that deal with that country. China this morning, June 11th, he talked about a deal with China being done, which was just agreeing to what the 2 delegations agreed to back in Geneva a week or 2 ago.
Mhm.
But yeah, gold surged dramatically on trade war fears, and so as market participants, excuse me, see less probability of like crazy embargo grade tariffs in the future, I think that may weigh on gold. And I think it might weigh on gold from the Chinese side as well, as they see more stability in what the U.S. is going to charge those Chinese export factories to import in the U.S. The other thing I'm worried about for a gold sell-off, this rolling over into correction still, is gold futures speculators, though they're positioning us low, their shorts are all slow. So they have huge room to short sell gold. They tend to watch the US dollar index for their primary trading cues. And gold and the dollar, of course, are inversely correlated generally, not always, but most of the time, as you know. And back in mid-April, when gold shot vertical, 26.5% above its 200-day moving average, the dollar fell to 95% of its own 200 DMA. And that's extremely oversold territory for the dollar. And since then, gold has consolidated high, but the dollar has also consolidated low. So over the past 2 months, the dollar has stayed near extremely oversold territory per the US dollar index. And so if we get that good trade war news, a big upside surprise in major US economic data like monthly jobs, which didn't happen last week, or CPI inflation, which didn't happen this morning, it was cooler. But still, we could get a big dollar rally, a mean reversion dollar rally, which would, spawn gold futures selling regardless of specs positioning. And that could push gold into a 10% correction still as well.
Mhm. So you mentioned the summer doldrums, Adam, and this idea, even applies to trying to get interviews, honestly. Like I, coming into the summer, I always get almost a little bit antsy because, most people are like, I'm not in the office. And it's even hard to be able to try to adhere to my self-imposed schedule of trying to do 3 interviews a week here. But where does the idea of the Doldrums originally come from?
You know, I had to have heard it somewhere like 20 years ago.
Mhm.
Um, it was just such an apt term. I'm really interested in history in that era of tall ships, and there's this zone around the equators where there's these long-lived low pressure areas. In the tall ships, the sailing ships, they of course had no propulsion but sails, no air conditioning, limited stores of food, limited stores of drinkable water, and they get stuck in the doldrums where there were no trade winds. You know, these high pressure zones, the hot air rising, to be stuck for weeks, days, weeks, sometimes a month plus here. It was just murder on crew's morale. They couldn't go anywhere. There wasn't much to eat. It was miserable. It was hot. It was humid. And so I think it's just a really apt analogy to what the markets feel like. If you're on vacation in June, it's awesome. But if you're around here like you and me working, trying to scrape out a living in the markets, you're just like, man, is anybody else around? Does
Mhm.
anybody watch these interviews? Does anybody read these essays? And just people are gone. They're checked out, and that's great. I'm glad they can take a break psychologically.
Mhm.
But it's in the 26 years again, I've been doing this. It's happened almost like clockwork every summer. I've done long-term seasonality studies in the doldrums, um, both in stock markets and gold, silver, gold stocks, and it's everywhere. It's kind of a universal concept. That stock market aphorism, "Sell in May, go away." I mean, that's been around for 150 years in U.S. stock markets. And so it's just a thing this time of year. People have other pursuits, other interests, and the markets take a back seat, unfortunately.
Mhm. Does it not have something to do with let's say, the momentum carried into the May close? I know you wrote about that. Does that, propel gold or interest as well through the summer?
It does, but it kind of works the opposite way. If gold has a super good spring rally like this year, if it rallies strongly in April, May, it tends to have a bigger sell off in June, just a mean reversion rebalancing type thing,
Mhm.
just normalizing sentiment and technicals. If gold is really weak in April and May heading into the summer, it tends to rebound, have that mean reversion bounce in June and early July. And so I've found momentum generally doesn't carry from May to June. It tends to reverse in June and early July. And you know, and again, if people are checked out and not paying attention, that makes sense.
Mhm. So obviously, there's not just the gold price itself, but also, we haven't seen these price levels for the silver market in, well over a decade. And even the last time we saw them, it was seemed to be far more volatile than it is now. So how are you, how are you looking at the silver market right now? And B, how long has it been also since you've even written about
Well, Tom, I'm embarrassed to say, I think it's been like 4 years since I've written a silver essay. I wite 52 weekly essays a year, and silver just hasn't been interesting enough or exciting enough to write about, or more exciting than gold and gold stocks, my usual bread and butter. I'm thinking about writing a silver essay this Friday though, and I'm going to do some research work on that today. But yeah, this Monday, which was the 9th, I guess, June 9th, silver made a 13.3-year secular high. It's in the 3650 range, and that's great to see. It's a major secular breakout. Um, Silver has really lagged this monster gold up leg, though, this mighty cyclical bull. Since early October 2023, again, gold's up 88.1% at best. Silver's plus 58.5% at best in that same time frame. And you'd expect silver to outperform gold. It's a vastly smaller market, way more leverage. That's what silver's historically famous for, is outperforming gold.
it?
And so silver's lagged way behind. Silver needs to do huge catch-up rallying. Um, One thing I need to explore that I'm looking at, I looked at yesterday in our weekly newsletter, and I'll probably look at more later today, is like gold futures positioning, silver futures, speculators, excuse me, silver futures trading has a big impact on silver prices.
Mhm.
And while gold's spec longs are 25% up into their gold up leg trading range, silvers are like 75% up into their trading range during this monster gold up leg. So silver speculators are much more deployed in silver futures. They're much closer to the point of buying exhaustion. And that kind of worries me over the short term. Um, I mentioned back in mid-November with the biggest pullback of this gold bull was 8.0%. Well, silver fell about 10.5% in that span, Tom. So if gold rolls over into correction, silver's probably gonna get sucked into it.
Mhm.
But silver needs to catch up with gold. Silver has a lot of rallying left to do, I think. these higher silver prices are great for building awareness. They're great for the few primary silver miners left, their earnings, and also plenty of gold miners that produce material amounts of silver as byproducts. So it's wonderful to see silver. And I think that's a good indication of sentiment. Sentiment's apathetic over the short term, right? But over the long term, I think interest in gold and gold stocks and silver is gradually growing. I think higher silver prices might be an indication of that. Just a gradual, slow increase of awareness of precious metals, which is just wonderful to see, especially among young people. We need a new generation. We can't have all the old dinosaurs dying off and no one interested in gold. And so, yeah, silver is really, really, really interesting here for sure.
In that market positioning idea that you just mentioned, Adam, do you think that basically the shorts getting caught in a squeeze here is something that is going to play into this market or can play into this market, or you have to study that more?
Anything is possible. A short squeeze is certainly possible. Spec shorts, unfortunately for silver, are also really low as well. They're like gold. They're down towards the bottom of their trading range. So, these guys, a short squeeze is when shorts buy to cover, right? But shorts are at the bottom of where they've been in the last 18 months for silver futures as well. I don't know what the exact number is, maybe 15, 20% up into that trading range. And so there's not much fuel right now for a short squeeze. The spec shorts have already covered. And so it's certainly possible, but I think we need a nicely rising gold price, good upside momentum in gold, and also high spec shorts to have a big short squeeze in silver, the kinds it's legendary for. And that's certainly not the setup today, unfortunately.
So, Adam, going back to, let's say, traditional drivers for gold, obviously the Fed has been a major catalyst both up and down for the gold price. Do you think that has changed, and what data do you think is most important to the Fed right now?
Oh, great question. That was a huge driver in recent years, as you know. Anything that moved the Fed rate trajectory odds, whether hiking or cutting materially, gold would move big on it. 1%, 2% plus days. For instance, the main data was big U.S. data, like monthly U.S. jobs Friday at the first Friday of every month, most of the time. Then the main U.S. inflation report, CPI inflation in the middle of the month, PPI wholesale inflation right after that. There's also PCE inflation, a different measure the Fed officials prefer. That's reported late in months. Sometimes GDP move gold. That's late months as well. U.S. GDP reports if it was materially different from expectations. I think there's a couple reasons why the Fed hasn't been moving gold much lately. The Chinese buying the foreign demand for gold from central banks and Chinese investors has been huge. That's kind of overpowered what American gold future speculators have done, which is great to see. Love to see the gold market expand and broaden. The second thing is, the Fed really hasn't moved rates. It cut a couple of times. It cut once, 50 basis points once before the elections, back in early November. The cut was like mid-October or September or something. And it cut one more time in September, 25 basis points. But since then, it's been on hold. Fed officials say that's because they don't know Trump's government policies are going to be, what the tariffs are going to be, what the tax policies are going to be. The Fed's hyper politicized, though. That's kind of a rabbit hole we probably don't want to get into. But anyway, the Fed hasn't moved rates since December. And so with the Fed not moving rates and with the Fed officials saying, hey, we're not going to move rates till we get more data to show us that we can, we're just not going to do anything. We're going to sit in our hands. And I think that's kind of lessened the impact of Fed rate trajectory, Fed rate cut odds changing on gold. Also with spec futures positioning, with spec longs so low, they're just not, those guys don't high enough positioning to really move gold futures with changing rate hike odds. There was So last Friday was Jobs Friday, Tom. It was really interesting. I watch Fed rate cut odds all the time too, and that was a slight upside surprise in jobs. Like 135,000 compared to 125, rough numbers, not exactly right. But there were also minus 95K jobs in past 2-month revisions. So the overall jobs report was quite weak. Yet the futures implied Fed rate cut odds for 2025 only moved from 48 basis points, 225 basis point cuts to 51 basis points. So we had a 3 basis point swing on data that really could have moved gold and gold futures in the US dollar in the past. And so I think people have kind of moved on from that focus since they don't see the Fed moving, since Fed officials said hey, we just got to wait for more data. And so that's kind of my perspective on that at the moment.
Yeah, I think, seeing this as the Fed, as you said, being hyper politicized at this point. There's lots of noise that even Trump made about having a new Fed chair picked out, and he's going to make this major announcement and all of this stuff. But we have to remember that he, at this point, as I understand it, doesn't have the ability just to oust Powell until the end of his term, which is just under a year from now. I think it's the end of May 26, right? So, there's so much news flow right now. There's so many things to be trying to pay attention to that I think it's actually more useful to figure out and focus on what isn't worth paying attention to rather than what is.
Yeah, it's always drinking from a fire hose, trying to separate the wheat from the chaff, the gold from the dross. Yeah, Trump has criticized Paul a ton. He does all these wild truth social posts, just shooting from the hip, just whatever his emotion in the moment is. They're kind of interesting because you never have to worry about what Trump thinks. Love him or hate him, you know what he thinks. It's never a surprise with him. And I think attacking Powell makes it harder for the Fed to cut rates, which is kind of contrary to Trump's purposes, because the moment the Fed cuts for any reason, some people are going to say they're just bowing to political pressure, But I think also Trump is trying to scapegoat the Fed because by blaming Powell for not cutting, Trump called him a disaster the other day, last Thursday when the ECB cut. He's calling Powell, his Fed chair, all these names. The Fed chair he appointed, by the way, back in his first term. By blaming Powell for not cutting, he scapegoats the Fed. And so whenever the jobs reports get bad, if GDP growth falls negative for real reasons beside export-import stuff, he can just say, hey, the Fed had rates too high. And he's got a point there. The current federal funds rate in the U.S. is 4.38%. And the European Central Bank just cut their main deposit rate to 2.0%, their eighth cut in a row last Thursday. And so rates are really high in the U.S. compared to the rest of the world. And, I think that's politicized, as you said. There's been most of the high Fed officials are Democrat donors, very few Republican donors. They have passed in Democratic administrations. If you look at the rate cutting history of the Fed, it's way, way more likely to cut under Democrat presidencies and Republican presidencies. There's something called the Financial Conditions Index that looks at how markets are faring, the looseness and tightness of Fed policy. There's a bunch of things that feed into them. But anyway, back whenever that Fed did that 50 basis point rate cut right before the elections, which a lot of people thought was to help Harris win the election, the financial conditions were easier or tighter. They were more conducive to a rate cut now than they were back whenever that was, mid-September, mid-October. And so there's just a lot of interesting asides on Fed politicization. But yeah, the Fed doesn't like cutting under Republican presidents. And one reason is Republican lawmakers attack the Fed as well. They think the Fed should have rules for cutting rates, that it shouldn't be as independent as it is. And so the Fed sees Republican control as a threat to its independence, which it holds very, very dear. And so there's definitely a politicized aspect to this, unfortunately.
Mm-hmm. So, Adam, moving into, let's say, another part of the gold market here, why are miners so leveraged to the gold price? What do they reward the investor or speculator for allowing capital to flow to them?
Yeah, it's just simple math and earnings. Mine costs are largely fixed and mines are planned. That's when engineers determine, the processing capacity of their plants, how many ounces they can feed through how many tons of ore they can feed through their mills every day. And so mining, the fixed costs of mining are known in advance before mine is even built. So when the gold price rallies, mining costs follow it slowly, but way more slowly. Say mining costs rise an average of 2 or 3% a year and gold's rising 20, 30% a year, like recently. You just have this huge profit margin open up as gold's rising way faster than mining costs. And that inherent profits leverage to gold is where gold stocks' huge upside comes from. And their earnings are just massive. After every quarterly earnings season, I do studies of the top 25 GDX major gold miners and the top 25 GDXJ mid-tier and junior gold miners, latest quarterly results. It's some of my favorite research work I do. I love the fundamental work. And for the past, I think it's 8 quarters in a row, the GDX top 25 major gold miners have had double-digit year-over-year implied unit profits growth, meaning the difference between the gold price and their average all-in sustaining cost, just absolutely massive growth, ranging from, like, say, 35% year-over-year to 90% year-over-year for 8 quarters in a row now. This current Q2, that's over at the end of June, is going to be their best quarter ever by far because of these record gold prices. Their all-in sustaining costs are rising, but way more slowly than the gold price. And so they're just making money hand over fist. Last quarter, Q1, they had They had record revenues, record bottom line accounting earnings, record implied unit profits, record operating cash flows, record cash on hand and treasuries. This sector is just printing money hand over fist. And that's one thing that's frustrating about the apathy here is value investors should be flocking to the gold miners. They're just making money like no other sector in the markets. Huge earnings, trading at lots of them in the teens trailing 12-month price earnings ratios, some single digit TTM PEs. Yet people just aren't interested yet, including institutional investors for the most part. I think that's an anomaly that'll close as gold powers higher and more people see just the incredible fundamental results these gold miners are putting up. They're absolutely incredible.
Well, what do you see as the reason for the market participants to start turning and start looking at miners? Is it the underlying metal that seems expensive, yet the companies that produce it are still yet to be rewarded for their margin expansion?
Yeah, momentum in gold is a big thing. All precious metal sentiment comes back to gold. So if gold rallies in balance, people will get more interested in it, and then they'll start looking to the miners. We saw that to some extent back in April when gold was rallying higher. GDX and GDXJ, the two major U.S. gold stock ETFs, started to really outperform, and they haven't outperformed at all in this secular or this cyclical bull. Again, gold's up 88.1%, Tom, and GDX is up like 96% in that span, and GDXJ like 109, I think, are the latest numbers. But normally, historically, the major gold miners amplify material gold moves by 2 times or 3 times. So they're way, way behind. The last 40% plus gold up leg crested back in like August 2020. It was 40% exactly. And GDX is up like 134.1% in that span. So 3.4 times upside leverage. And so I think gold stocks have huge catch-up rallying left to do. But yeah, momentum in gold will be a big thing. But also I think that the U.S. stock markets have been chronically overvalued, trading in bubble territory for years now. I define bubble as more than twice the long-term average trailing 12-month price earnings ratio of the U.S. stock markets. Fair value is 14 times over the last century and a half. So double that at 28 times earnings is where bubbles start. And right now, the S&P 500 is trading around 30, 31 times earnings. And so we're really overdue for a bear market in the U.S. stock markets. It's been a long, long time. And I think as U.S. stock markets roll over and weaken, that will spawn interest in alternative assets, including gold and gold miners. And so I think we have to get the focus off the AI stocks as well as see some gold momentum. And then people should really start paying attention to gold and gold miners again, which should be absolutely fantastic for this sector.
Well, Adam, as you're saying about the AI stocks and, different pieces of the market like that, I had a listener question come in yesterday asking me if I could ask guests about the idea of how much the crypto market has really taken away from the precious metals market, and what prices would be for the metals if the crypto market didn't exist. My answer to him was kind of, we can't just point at the crypto market. We also have to point at, the AI bubble, all of this other, let's say, passive investment flows as well that people have gone into. So I don't think we can just point at the crypto market as being the only, piece of the pie that has, in a roundabout way, taken away from the precious metals markets. What are your thoughts towards that?
I agree with everything you said there. Crypto, especially Bitcoin, has to have taken significant capital away from gold and silver, especially among young people. My kids are middle school age. They play high-level competitive basketball. So almost every weekend we're at basketball tournaments, and I volunteer to do scoring at most of their games. I love being in the front and the center, the action. I know most of the refs. I know all the coaches, a lot of the players, and a lot of the coaches are younger people. And they know what I do. We've talked for years, and we talk about investing, and especially amongst younger people, Bitcoin and Ethereum and the top cryptocurrencies are huge, huge things. And they saw Bitcoin go from nothing to 105,000, and they're just so excited about it, which is totally understandable. But I think that has taken a lot of interest away from gold amongst the younger people. I don't know, under 30, under 25, maybe under 35. And that has to have affected gold. There's also institutional investors, big funds. They want to do what's popular because that brings more assets under management in their fund. And of course, those guys are paid in a percentage of assets each year. So Bitcoin has been really hot in recent years, and people are really excited if some fund's going to have a Bitcoin allocation. They think they're hip. They think they're technologically savvy. They're more likely to get capital inflows, and gold's kind of seen as anachronistic, old, dusty, Keynes's barbarous relic. And so I think crypto has to have taken significant capital flows away from gold. I don't think it's going to replace gold, but Bitcoin has had an incredible run. One saving grace for that is Bitcoin has tended to trade more like a tech stock proxy, like it tends to track mega cap technology stocks more than gold. And so if the US stock markets roll over, when they roll over, when this tech bubble, this AI bubble bursts, Bitcoin's probably going to sell off as well. We've seen that in recent months too. Bitcoin's highly correlated with the NASDAQ. And so that should help boost interest in gold as well. Bitcoin should take way bigger losses when the NASDAQ corrects than the mega cap techs do. And if that happens, I think some of that zeal for Bitcoin will get dampened, just like in a gold correction or a big gold sell-off. So that should help gold. I think Bitcoin's really fascinating. There's something to it. I don't like any of the other cryptocurrencies, but Bitcoin itself is really an amazing thing. It's that hard limited supply of, what is it, 21 million Bitcoins forever.
Mhm.
And so Bitcoin has some real merit. And I understand why young people are allocating capital to that rather than gold, and also institutional investors.
Mhm. Well, I think, many times people, want to pick a team, and it turns out that, through many of the discussions that I've had with Bitcoiners, we're on the same team. We're on the idea of, sound money, and money that governments don't necessarily have control of. And there's a lot of kind of talking past each other in a lot of those types of discussions, which I don't think is helpful. I think we should, have an open mind to be able to understand, or at least entertain somebody that theoretically disagrees with you. But
Yeah, sorry,
go ahead.
Tom, go ahead. It's not an either or thing. Everybody
Mhm.
can have Bitcoin, everybody can own gold. I've always recommended a 5% to 10% portfolio allocation in gold. The rest can be general stocks, tech stocks, whatever, Bitcoin, some gold stocks, but people don't have to be all in Bitcoin, all in gold. They shouldn't be all in
Mhm.
anything. One of my favorite verses from the Bible, Ecclesiastes 11:2, talks about diversification. Cast your portion to 7, even unto 8, because you don't know what disaster may come upon the earth. It's an ancient principle to diversify.
Mm.
And so we don't need to be all in gold stocks. That's actually pretty foolish. We don't need to be all in crypto, equally foolish. People should have diversified portfolios, and Bitcoin's a great part of a portfolio, just like gold. So yeah, we can all be happy together for sure.
So, Adam, going back to the idea of miners, how do you, let's say, separate the world of the miners? What role do the majors play within a portfolio versus, let's say, mid tiers?
I'm not a big fan of the majors, Tom. I haven't been for years. I've studied these things for decades and looked at every quarterly results. And the majors I define as over 1 million ounces a year production. They just have a tough time growing their production. They operate at such vast scales that they can't overcome depletion. They can't bring enough new projects online to just replace whatever they're mining. And the way they get around that is they do these super expensive mergers and acquisitions. They way overpay for other gold miners, smaller gold miners, and then because they overpay for them dramatically, they have to write off that goodwill in future years. And so their net earnings over a long period of time are negative. They overpay for these gold mines, they write them off later, and they can't grow their production. Their market caps are too big. Their all-in sustaining costs are too high. So I tend to avoid majors entirely. That's my biggest problem with GDX, the most popular gold stock ETF. The top 12 or 13 positions in it are all majors, and most of them are dead weight. These stocks don't do well at all, even when gold rallies. But the mid tiers are the sweet spot for gold miners. GDXJ, the smaller, they call it the junior gold stock ETF, but it's really almost all mid tiers. Mid tiers defined as 300K to 1,000K ounces per year. Juniors under 300K. Those mid tiers are in the sweet spot. They're not small and risky like juniors. They usually have 2, 3, 4 mines. They're diversified. They have lower costs than the majors. They're better able to grow. If they have one expansion at a mine or one new mine coming online, they're going to have huge growth for a year or two. And so it's much easier to find growth in the mid-tier realm. And investors prize production growth above everything else because that generates the cash flows necessary to expand mines, build new mines, to keep growing. You can't grow unless you have funding to fuel that growth. But when you have it, you can keep growing
Mhm.
and keep growing, building your stock price and making your shareholders wealthy. And so mid tiers are where it's at, in my opinion. I avoid the majors almost entirely. There's a couple exceptions, major level gold miners that have really good cost structures and have done well, but for the most part, they're just dead weight.
Mhm.
Not worth investing in.
So, in that idea, when you're saying that the majors end up overpaying for M&A targets, let's say, is that again, one of the sweet spots, as you put it, to really focus on in the event that they get taken out.
Yeah, it's definitely an added value proposition for mid tiers and juniors. They're likely to get gobbled up at some point.
Mhm.
I don't write about it often because I'm always sad, Tom, when I have a great mid tier and it gets bought out, just kind of absorbed into the Borg of a larger major. I'm like, man, we got like a 15-20% premium, but this stock could have doubled or tripled over the next 2 years if
Mhm.
it wasn't just one of 20 mines a major owns. So I find it always disappointing when one of my stocks gets bought out. I get a little premium, but I lose years worth of upside. So I've never liked M&A even from the mid tier side. The premiums are too low. It takes out good companies. It's always hard to find emerging juniors that are growing into mid-tierdom that could grow into majordom just because there's so many purchasing, so many are taken out over time. And so, yeah, it's a slight benefit of owning mid-tiers, but investors are better off if mid-tiers can exist longer themselves than be taken out at small premiums by the majors and just then their mines won't contribute much.
Mhm.
Another thing crazy, Tom, is that when the majors buy a mid-tier, you'd think that the mid-tier's lower cost mine would lower the major's cost structure, but many times over the past decades, I've seen like the majors buy like even another major, and rather than the new cost, the all-in sustaining cost being a blend of the prior two companies, they rise over time. Like the majors somehow have this administrative bloat, this middle management layer that just makes everything more expensive,
Mhm.
and so they tend to wreck mines they buy as well, which is just unbelievable. I don't know how that can happen. That's crazy.
So, Adam, have you looked at, let's say, the dollars spent by the majors on exploration, or let's say just within the sector overall? Is that, a cyclical piece to the gold bull market that ends up kind of being a catalyst or a signal point for the market itself?
That's a fantastic question. I've not looked into that, but it's a great idea. I really should throw that into my quarterly analysis every quarter. My understanding is that, or what I've seen just anecdotally, is that the gold miners love to explore, but they need to be able to have decent stock prices. They like to issue stock to pay for exploration and mine builds and stuff like that. So when gold stocks are out of favor, their stock prices are low, and they have a tough time selling stock. They just don't. People aren't moving capital into this sector, and so exploration tends to wane. And of course, the lower exploration is, the less gold production there's going to be 10 years in the future. It takes about a decade, as you know, to bring a mine from a deposit through full permitting to an actual mine.
Mhm.
And so, yeah, I think that exploration's been low based on anecdotal reports, based on what I've heard from miners and fund managers. I think exploration's been really low for the past decade, maybe since 2013. I think it was 2013 when gold had this huge drop on some Fed machinations, and that really damaged confidence. So for the past dozen years, effectively, gold miners have been out of favor for the most part. There have been exceptions here and there. And because they've been out of favor, they just haven't had the capital inflows to finance the exploration budgets necessary to, replenish depleted production. And
Mhm.
so that's definitely a bullish factor for gold going forward.
Excellent. Well, Adam, that's all the questions that I have for you today. Is there anything that you'd like to leave our audience with before we wrap up here?
The summer doldrums are a great time to do your homework, Tom. If your viewers are interested in gold stocks, now is the time to be looking for great mid tiers, great juniors, excellent companies to deploy in. If gold corrects, there might be a few days, a few weeks on the outside to buy these stocks relatively low, and so you gotta persevere. Even when the markets are boring, you gotta stick with it. Do a little homework every week and build a shopping list, because when that buying opportunity comes, it might not last very long.
Mhm. Well, and of course, your site is a great place to do some of that homework. Of course, Zeal, ZEALLLC.com, where, as you said, you write a weekly essay and you have some, let's say, subscription based options as well there, right?
Yeah, we have a weekly and monthly subscription newsletter, paid subscription newsletter, and then a free weekly web essay. And so, yeah, I read about gold and gold stocks, fundamentally, technically, sentimentally. Been doing it for 26 years. Yeah, I'd love to have your viewers stop by and check us out.
Excellent. Adam, thanks so much for all your info and expertise today.
Great chatting with you as always, Tom. Thank you so much, man.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.